Welcome to the Circle of Trust, the podcast where campaigns and strategies to grow law firms are unveiled. Hosted by law firm Chief Marketing Officer Keith Dyer, the founder of LEXGRO, this podcast is dedicated to being a safe and objective place to educate and train law firm owners and personnel on the marketing secrets and strategies that bring in consistent cases and predictable revenue. Whether you're a solo practitioner, a small firm, or a multi-partner law firm ready to scale, this podcast and the LEXGRO platform are your trusted go-to source for objective and cutting-edge marketing and intake training. And now, law firm Chief Marketing Officer Keith Dyer with the Circle of Trust.
Hello and welcome to another edition of CMO Secrets. I'm Keith Dyer, again, your host. CMO, of course, stands for Chief Marketing Officer. And today we are going to talk about law firm funding and how you can get money to grow your firm. I'm joined today by my friend Ari Kornhaber. And Ari and I became familiar with each other through me meeting some of his associates at PILMA, Personal Injury Lawyers Marketing and Management Association, at the conference they have down in New Orleans. And I got to learn about his bank, Esquire Bank, and some of the things that they do with law firms in terms of getting them the money they need to grow. And it's very impressive outfit. I don't want to take up too much more time with the intro, though. I want to say, hello, Ari. How are you?
Good morning, Keith. I'm doing great. I appreciate the opportunity to have this business conversation with you. So thank you.
Yes, thank you. Thanks for coming on and giving us some insight. Give us a little about your background. I know you are an attorney, and so that gives you some really great insight into what law firms are facing when they're trying to grow. So tell us a little bit about yourself.
I'd be happy to. Yes, I'm a lawyer and a banker. Not always the most popular combination in certain settings, but at organizations and conferences like PILMA, it actually is. So yeah, I represented injured plaintiffs in personal injury, medical malpractice, and mass tort litigations in New York City for a number of years. I always like starting that way because when I'm speaking to lawyers and law firms on behalf of Esquire Bank, it kind of lets the audience know, and today's audience know, that I've walked in your shoes. I've tried cases to verdict. I know what it's like, to represent injured individuals and their families when they are at the lowest of their lows and helping to try to put their lives back together. And also the business aspects of what it means to be a contingency fee law firm. I've done that. I know the financial pressures. So it gives me really interesting perspectives and an insight into the business of practicing contingency fee law.
Great. And there is a big difference in that, the contingency, non-contingency fee, and the risk that is involved with when you're working in a contingency fee environment. Tell us a little bit about the history of the company and the kinds of loans that maybe you guys provide, and a little bit about maybe your ideal client and that kind of thing, the ideal customer. What does that look like?
Sure. Maybe it could help if I start giving a little more background about how Esquire Bank was born, because we've evolved quite a bit over the last decade and a half plus. So the idea of a national commercial bank that took the time to understand the business of contingency fee work was brought to me and my partners about 19 years ago, and became apparent that there was no bank in the country that took the time to understand the business of being a contingency fee law firm. And we did. We took 2 years really studying the industry and speaking to corporate lawyers, contingency fee lawyers, and business consultants about starting a bank for this industry. And all of the science came back as, yes, this is an industry that was underserved, underserviced, and misunderstood, right? And why is that? You referenced it. When you work on a contingency fee basis, lawyers don't generate revenue unless and until they successfully resolve cases. Therefore, their revenue, their cash flow is extremely irregular compared to other businesses. And that creates all kinds of issues for lenders. So traditional banks do not like lending money to contingency fee law firms. They believe that there's just too much actual credit risk lending money to a contingency fee law firm. That's the general statement, but I'm going to pull the curtain back now and tell you why they think there's too much actual credit risk. There's a few reasons. If you look at the balance sheet of a contingency fee law firm, there are no assets on the law firm's balance sheet. So that creates a problem for traditional lenders. There are no assets to lend against. Then traditional lenders say, all right, well, maybe there's AR. There's no real AR, right? AR, if you're a contingency fee lawyer, maybe a settled case that's just waiting to pay. But if that's a single event case, that typically pays in 30 days or less. Traditional banks like lending money to companies that have regular cash flow, that's not lumpy, that has AR that monetizes in 90 days or less, or if they're really progressive, 180 days or less. Whereas, a case that's in litigation could take on average 2 to 3 years. So a traditional lender can't do that. And then you look at the inventory of contingency fee law firms. Again, traditional banks can't lend against it because they can't touch and feel it. The inventory of a contingency fee law firm is comprised of the active cases that they're currently working on.
Yeah.
Those cases, by their very definition, could be worth zero or maybe worth some sum of money down the road. Again, a traditional bank can't wrap their arms around that and believe there's just too much credit risk lending money to those types of law firms. Now, we think they're wrong. They just don't understand it, as we do. We believe it's a perceived credit risk that we've named a duration risk. So now Esquire Bank is in our 17th year of business. We're very fortunate that we work with some of the top law firms around the country, hundreds of law firms now. These lawyers and law firms are very selective in terms of the cases they elect to work on for obvious reasons. They're not going to get paid unless there's a successful result. So they're selective. And in our experience, now doing this over 17 years, the cases that they elect to work on monetize over 95% of the time. So to us, it's not an actual credit risk. It's a perceived credit risk that we've named the duration risk. And Esquire Bank and our underwriters are very comfortable with that duration risk. So if you start there, it allows us to do what no other bank in the country is comfortable doing, lending into the gaps in cash flow, coming up with repayment terms and structures that are aligned with this business. So at the end of the day, Esquire Bank, we are asset-based lenders. We lend against contingent assets, two of them. One, the future projected attorney's fees, and number two, the reimbursable case costs that are laid out on those cases. And I'll finish with this slide. We separate that docket, that active docket, into two separate asset classes, future projected fees and reimbursable case costs, for an obvious reason. The future fees will be the law firm's revenue. The case costs get repaid out of the client's share of every settlement. So by separating the two into separate asset classes, quite frankly, we could just make more capital available to the law firms that apply for financing from us.
I love that. That's great. And I live this life with you in a way, because I go out and I'm the guy that's responsible for buying the cases because I deploy the marketing, and then I watch the fret that goes on, the hand wringing, and the dips in the cash flow, and waiting for it to catch up, and then it catches up and everybody's happy again, and we go borrow more and keep trying to grow more. So I get that. And I think it's great. You guys have found it's really fascinating. Like you're right. It only would be lawyers that could understand how this works. And so that's why you're perfect for this, right?
I can't tell you, Keith, almost every day I have an opportunity to speak to a lawyer, either on a video conference call like this or in person. And almost every day I hear feedback like, it is so refreshing to speak to a bank that speaks our language, that understands our business. These lawyers are frustrated because they all have banks. They need banks for their IOLTA accounts and operating accounts. And those are really valuable accounts for banks. So when the lawyers go to those banks to talk about financing, they get this glazed donut look on the face of the bankers because they just don't understand it. It's not their fault. They can't.
They can't understand it, and their directive and their job is to make sure that they have all the bases covered. And unfortunately, in this business, those bases can't be covered, right? So I get it. And so let me ask you, in your opinion, when should a firm be looking to borrow capital? Like, at what stage of their growth do you feel like it's it's the best time for them to borrow, and if that's even possible to determine. But just in your experience, when do you see someone come in and you say, oh, that probably isn't the right time for them, probably not a good time to loan money to them, and when is it the right time? Like, is there uh, a way to determine that in your?
There is, let me start by saying we consider ourselves tailored financial solution providers. Every law firm we speak to is unique. Even if we speak to two law firms that both do single event personal injury and their active docket is comprised of mostly motor vehicle accidents, some premises liability claims, and then maybe something else, some limited mass tort, things like that. Every law firm is different, so we tailor our financial solutions around each law firm because they're unique. But when it comes to when should a law firm start considering financing, I think it should be part of their thought process from the very beginning. Now, look, if a lawyer or a couple of lawyers just graduated law school and hung up their shingle and they came to Esquire Bank for financing, it's probably too soon. I use an extreme example to make the point. But they should know where they are in what we call the growth cycle or the life cycle of a law firm. So to that point, Esquire Bank created something called the Growth Assessment Tool. And it's an online tool where a lawyer could go and answer some simple questions. And based on the answers, we tell them where we believe they are in the growth cycle of a law firm. Everything from a growth starter to a national law firm with offices in multiple states, the other end of the spectrum, and everything in between. And we give them some tips and ideas on how to get to the next phase. And some of that obviously includes financing. But in order to get the financing, we say you need to have your house in order, right? So that means a couple of things. It means really understanding your docket of active cases, because if a law firm that does contingency fee work is going to apply for financing with Esquire Bank or another lender that understands this business, those other lenders are typically litigation funding companies, we lend against the active docket. So if the law firm has a good handle on the value of that docket, and that could be a gross value, it could be net fees to the firm, those types of projections become really valuable. A lot of law firms have yet to do that. Depending on the type of practice that they're in, there's more than one way to approach this. If a firm, for example, does just a high volume of motor vehicle accident cases, typically pre-lit settlements and all of that, historical data can be applied to make projections going forward, right? Average gross value, average net fee to the firm, average time on desk or duration, from retainer to release, things like that. You could apply those going forward. If a firm on the other end of the spectrum does single event, but only has a limited amount of high value, low volume cases, then we suggest that those lawyers really go through those cases and put some projected values and timing on those cases. Because when Esquire Bank looks to provide capital to a contingency fee law firm, the first thing we do is, with the lawyers, look forward 3 years and say, what are you projecting to generate in fees over the next 12, 24, and 36 months? And how much do you have out in case costs? Again, that's what we lend against. That's how we determine the LTV, the loan to value. So when is a good time for a law firm to start looking for financing? After they have a handle on the value of their docket. Otherwise, they're just going to be limited to the financials from the past.
Right.
Any bank could look at your last 3 years' tax returns and tell you how much they can lend you. But if you're a growing law firm and we bring the most value, talk about ideal customer profile, we look for law firms that are trying to grow, okay? And if you're in growth mode, 2 years from now is going to look very different than 2 years ago. So if you don't have any types of projections in order, and we're limited to looking at your financial history, and those financials represent cases you resolved in the past, you're doing yourself a disfavor, right? And not going to get access to as much capital. So number one, understand the value of your docket. Number two, understand your expenses, right? What do you have a marketing budget? And do you have a marketing plan? How are you spending money in marketing? Do you have somebody who's focused on the firm's financials? the firms that have either a CFO, a fractional CFO, something more than just a bookkeeper and someone who does their taxes, it's very apparent because when those law firms come to us and say, we'd like to apply for $5 million in financing, they say, we believe we qualify, and here's why. That CFO sends us the information in such a nice, neat package. It makes it much easier to underwrite as opposed to the lawyer who's also the manager of the law firm, who's also doing the financials. Like
Yeah.
you can tell right away the quality of the financial information that we receive. So have your house in order in terms of your docket, your finances. Is someone focused on your finances? Who's doing the marketing? Are you outsourcing all of that? Do you have someone in-house who's always thinking about that? These are really important pieces, just like every other business. If you look at any other industry, those businesses have the right people in the right seats, focused all day, every day on those responsibilities.
Yeah, that's great. I love the fractional CFO model too. I have, as part of what this podcast and what we're doing here today is also going to be a section of the master class that I'm teaching, and that's taught in conjunction, this section of it, with a guy named Ryan Kimler, who's a fractional CFO, and he and I put together a pretty cool spreadsheet that law firms can use to project how much money they're going to need and when it will be paid back. I'll share that with you at some point. But how can they find this growth assessment tool? And can we put a link in to that, or can we tell them where to find this?
So I just dropped it into the chat. Will that appear to the listeners going forward, or is there a different?
Yes, it is here, and I'm gonna add that on our section as well, so they can go straight to it and use it. I think that's terrific, and I'm looking forward to going there and checking that out. So tell me, I mean, if you've kind of touched on it a little bit, are there, and this might be a difficult question to an extent, but what kind of qualifications, without getting into like extreme details, just generally are you looking for when, say a firm does know the value of their cases and they've got the things that you set in place, what are just some of the basic qualifications you might like, your LTV you mentioned, like what that might look like,
Sure. So there are two types of financing sort of structures within Esquire Bank. So if a law firm's willing to share with us their active docket, and together we could make those projections and look at the case costs and come up with the LTV. And then we also look at some recent financials. We look at those differently than traditional banks in a more progressive way, because no 2 months are alike for contingency fee law firms. No 2 quarters are alike. No 2 years are alike. And we're okay with that. So we actually look at an average EBITDA and can add back marketing expenses and, the owners of the firms, what they take home. There's some really cool things that we do with that. Those are the two pieces of the puzzle: the forward-looking projections and then the historical financials, which have debt service coverage, ability, sort of historical information in there. And depending on where things come out, we either provide financing that is supported by both the projections and the historical perspective, and we call that more of a cash flowing deal. And then there are those where the financials don't support the amount that the firm may be looking to borrow, but the projections do. That becomes more of a true asset-based loan, where we're really relying much more on the forward-looking projections than the firm's historical ability to service this debt. So that allows us to provide financing to a much wider group of law firms. And, I don't want to get too deep into the underwriting criteria because we'll just lose everybody's attention. But, it's an interesting way. When it's an asset-based loan, I think this will resonate. We look at what's settled that hasn't been paid yet, right? And sometimes those are wrongful death cases or minor cases where you need judicial approval. So those could take months, or maybe the firm does some class action or mass tort where there's a master settlement agreement executed. Maybe funds are in a QSF, but they're waiting for liens to be reduced and things like that. So that we lend up to 75% of the firm's fee on any type of settled case like that. Then again, we look at what's projected to come in years 1, 2, and 3, and we let the firm borrow up to 50% of anything that's projected to come in year 1, 25% in year 2, 10% in year 3. So we create this borrowing base for law firms so they know at all times what their borrowing capabilities are based on their active docket, which is constantly changing. They're
Yeah.
settling cases. They're bringing in more cases that are evolving. So it creates a really, really nice approach so that the borrower, the law firm, and Esquire Bank, the lender, know where they are every day of every year and what their borrowing capabilities are.
Yeah,
For
that's
firms
great.
for firms that aren't doing the asset-based borrowing where it's supported more by the cash flow, it's really interesting. We always start with how much are you looking for? What we don't like to do is have a law firm come to us and say, how much can we borrow? We'd prefer the law firm to say, we'd like $5 million. Of that, we'd like to keep $1 million of it in dry powder and what we call a working capital line of credit, just for short-term business needs in case they have a couple of slow months for overhead, payroll, those types of short-term business needs. Then sometimes they want to carve out some of this availability for case costs. And I think you and I should spend a moment talking about that, because what an opportunity contingency fee lawyers have to create liquidity and increase profitability by financing their case costs. And we do that in a unique way. And then growth. If the firm wants to invest in growth, invest in case acquisition strategies, marketing, branding, opening a new office, maybe acquiring another law firm's docket, maybe a partner buyout opportunity, things like that. We'd like to hear that too. And then, again, looking at the cases and the financials, we could come up with the right allocation of the availability across those different use cases, each of them with their unique structures and repayment terms.
That's great. I'm actually sitting here taking some notes. Do you want to talk a little bit more about the financing case costs? You said you wanted to spend some, yeah.
Yeah, and I'll start with my experience when I was practicing law. I practiced at 2 law firms in New York City, one for 3 years. Then I went to a bigger firm that also did PI, med mal, and I got into some mass tort. And the second law firm, when I first joined them, I'll never forget the first time I settled the case and the client came in to sign the release. I presented the client with an itemized statement of all of the case costs that we were going to get reimbursed out of the client's share of the settlement. And there was a line item, Keith, that said interest. And the client asked me about that. And it wasn't a big amount, but I had to excuse myself. And I went to the managing partner's office and I said, Jerry, we can't charge our clients interest. That's against the rules of ethics in New York. And he said, we would never do that. What we do is have a line of credit that we draw down from to pay for our case costs. And I said, really? I said, wow, that's very interesting. And I said, but you guys just made so much money coming off this pharmaceutical mass tort that just settled. And he said, yeah, but what do you think we're going to do? Put our after-tax dollars into our case costs and just have that money depreciate over time? That's not smart business. So it was eye-opening. I went back, explained that to the client, no issue, signed off, and off we went. The firm at the time was financing their case costs through a litigation funding company. So the money was 18% interest rate money, but still no issues with the client. So eye-opening experience. Now Esquire Bank studied this and recognizes that the rules of ethics allow contingency fee lawyers to finance their case costs. And the interest that's charged can be treated as a case cost itself and repaid out of the client's share of the settlement, provided that that arrangement is disclosed in the original retainer agreement.
Okay.
So we have the rules of ethics to provide to the law firms. We also have sample retainer agreements that incorporate that pass-through language. Now, here's what becomes really interesting. We know that today about 75% of contingency fee law firms in America do not borrow money. They are what we call self-financed. How do we know that? Because if a law firm is borrowing money from a lender, that lender protects themselves by filing a UCC-1, telling all other potential subsequent lenders that the original lender, is in a UCC first lien position.
Yeah.
Right? That's public information. So we are extremely data-driven, and we have information on every law firm in America, that publicly available information that we're constantly enriching. So we could put a map of the United States up on a screen and put all the law firms in America on that screen. Then we could just show contingency fee law firms. Then we could show contingency fee law firms with no UCC-1s filed. And there they are. And again, that's about 75% of all contingency fee law firms in America. So those law firms that are practicing trial litigation work are self-financed. They're using their own revenue to pay for case costs.
Mm-hmm.
Okay. They are essentially giving their clients loans with their after-tax dollars. Those lawyers have earned their fees, paid their taxes, and a portion of those fees go to case costs. And they're not charging their clients interest. So self-finance law firms that use their law firm's revenue to pay for case costs are giving their clients interest-free loans with their after-tax dollars. That's just not a great business model when there are better alternatives.
Sure.
Alternative one, that law firm could just get a line of credit for their case costs. And instead of using their after-tax dollars, they could draw down from this line of credit, pay for the case costs, the interest that they're charged, they could write off as an expense and on their law firm's tax returns, reducing their taxable income, freeing up their money that's locked in their cases and case costs to do something accretive. Maybe invest with you for case acquisition,
Sure.
or
Yeah,
put it
buy
in a
more
money
cases.
market account that today is earning 5%, or pay for their kids' college tuitions or their weddings. There are so many better uses for a law firm's after-tax dollars than just sitting in their cases depreciating. So that's option number one. Option number two is what I was referring to moments ago. Better yet, incorporate that pass-through language in your retainer agreements, get a line of credit for your case costs, finance them, pass through the interest to your clients. The law firms that do that, Keith, essentially are getting interest-free loans for their case costs.
Yeah, it's brilliant.
Now put it side by side. Today, they're giving their clients interest-free loans with after-tax dollars. Together, we could show them how they could get interest-free loans for their case costs. It's a no-brainer from a business perspective. Now,
I
not
think
only
it's terrific. I did not know about it either. Thank you for educating me.
absolutely, and I'm going to share something with you in a moment. So, look, at the end of the day, it can't be just a financial solution, okay? Because the rules of ethics state you're only allowed to pass through the interest that actually accrues on each disbursement that you're financing. So the equity partners of law firms who hear this go, oh my God, that's a no-brainer. Why haven't we done that yet? We're going to do that. And eventually they're going to go, oh, but poor Barbara, a bookkeeper, this is going to be a nightmare for her. Well, no, we've created and developed proprietary software that does all of the tracking of every case and does the accounting of the interest that's accruing on each disbursement that you're financing. So you could finance these case costs and outsource all of that administrative work to us. We will ensure that you're compliant with the rules of ethics. We will provide 100% visibility and transparency into this. All of this is visible on your online banking at esquirebank.com. You'll see all of your cases, the amounts you financed, the interest that's occurring live, real time to the penny. And there are now hundreds of law firms around the country who are taking advantage of this with us. And they've given us video testimonials just raving about how it's much better for the law firm, better for the clients in so many ways. And a lot of this information, Keith, resides on something called Lawyer IQ.
That's what I was getting ready to ask you about. Thank you.
Yeah. So I know I took a while answering your question, but
it was fascinating, and I think it's terrific, and so glad that are going to be able to share it on this podcast with all the contingency fee firms out there. One quick question I did: do you guys do many loans for non-contingency fee firms? I know that your specialty is and your niche is the contingency fee environment, but what about non-contingent law firms?
Yes, we are attracting defense firms, hourly firms, family and trust attorneys. Esquire Bank is really built on technology. We're not a brick and mortar branch network. We think that's an antiquated model. Most of the firms we work with are not in a cash intensive business. So we give the technology that you find in bank branches, we give that away to the law firms that work with us. And to that point, any law firm that banks with Esquire Bank banks with us for free. We do not charge them anything to bank with us. We do not charge them wire fees. It's amazing how many banks are nickel and diming their law firm clients. They're charging them for outgoing wires, ingoing wires. I hear every day that banks are charging their law firms for what's called positive pay, check fraud prevention. That should be given away. It protects the banks and the lawyers' idle accounts and their operating accounts. We give that away. When a law firm needs to order new checks and check stock, we pay for that. We don't charge them anything.
That's awesome. Yeah, that's terrific.
It is. But wait, what was your question?
No, about lawyer IQ. You were going to kind of delve into that a little bit.
Yeah. So we created a content hub called Lawyer IQ. I dropped the link in the chat box as well. We're always learning from our clients. And when we see some law firms that we work with for years experience exponential growth, then we dive into the data. We'll look at their financials when they came to us, and we have their prior 3 years financials. Then we see the financials for the years that they're working with us. And when we see hockey stick growth projections and actuals, we study that and actually bring that data back to the law firm and say, hey, you've grown over 300% over the last 3 years while working with us. Tell us what you did with the financing we gave you. And together, we learned that the law firm, when they were with the traditional bank, had a small line of credit. They came to us and were able to get a line of credit 3 times the size what they had. That allowed them to increase their marketing efforts, to hire more lawyers. As a result, their revenue increased and everything grew. And we write up some of these learnings in case studies, and we put these case studies on Lawyer IQ. We sometimes have video conversations recorded with the law firms that we work with, sometimes with their CFOs, and say, tell us about your experience with the traditional banks and how that differs from working with us. We have conversations with those that are coming out with new legal tech that's disrupting the industry. We speak to accountants who work with contingency fee law firms who talk about how to deal with phantom income and the benefits of case cost financing. So on Lawyer IQ are all these different channels, depending on what you're looking for. There's intake, accounting, marketing, technology, growth, obviously financing. So depending on what you're interested in, it's all housed there on Lawyer IQ. And the more you go there, there's some AI behind the scenes. They'll suggest other things for you to consume going forward based on your behaviors. It's proven to be a wonderful tool.
Yeah, that's terrific. And I'm gonna include the link inside my masterclass, so anyone can any law firm that's in my sphere of influence can go check this out. And I'm looking forward to going and looking at it more too. You've given me some terrific information here today, and I think very educational for the law firms that are listening to the podcast. You had also mentioned a couple other things you said you wanted to talk about. One was some of the social justice things you guys are doing and giving back to your community or whatever. So elaborate on that a little bit.
Yeah, I will. And I realized that I don't think I answered your question two questions ago when you talked about defense firms. So we've done such a good job with contingency fee law firms that a lot of plaintiff lawyers tell their defense lawyer friends about us, and they're coming to us. When COVID happened and the shutdowns and all of that, Esquire Bank became an SBA-approved lender solely for the purpose of providing PPP loans to our clients and some other law firms. And we did a really good job with that, always giving these law firms access to people who could tell them where their application was and what stage. And we bring real relationships to the table, Keith. So we judge our success by the success of the law firms that we work with. So because we're reliant on the best technology that's available, and because we're so focused on the relationships, that's just attracted more and more corporate law firms, defense firms, and all of that. So, I mean, the vast majority of the firms we work with are contingency fee based, but more and more, all types of law firms are coming to us because they're with other banks and they have truly no relationship. They can't get anyone on the phone with decision-making authority. With Esquire Bank, you never call a customer service number and have to wait online. You get people to answer the phone and answer your questions. So that's that. Now, social justice. This is something that is really important to me and Esquire Bank. And I'll tell you, it starts with the chairman of our board of directors. He's a former congressman named Tony Coelho, who literally authored the Americans with Disability Act, the ADA. So It starts from the chairman of our board down through our board of directors and myself as a founder and our executive team and all the employees. We believe that trial lawyers are doing such important work, righteous work, and we don't think that it's recognized enough.
Agreed.
And I'll never forget when I was a trial lawyer, that when someone used to ask me what I did for a living, I would often dance around using the words trial lawyer or personal injury lawyer. I'd say, oh, I'm a lawyer. Oh, what kind? I do litigation. Oh, what kind? I do civil litigation. Oh, what kind? Oh, I represent injured plaintiffs and personal injury. Oh, you're an ambulance chaser.
That's right. Yeah.
And that would just, to my core.
Yeah, it's a terrible stereotype because the real bad guys are the insurance companies. I mean, let's just be honest. They're the ones that are trying to take money away from you or not get you what you deserve. So you need a lawyer, and so they do great work. Is your point, right?
Yeah, and it's ironic, right? Because everybody who's listening to this has insurance, whether it's auto, home, you name it, and you make your premium payments on time every month, every year, hoping that you never need them. And God forbid you have a claim. Now they're trying to pay you as little as possible. But the lawyers are the greedy, money-hungry attorneys. And the insurance industry is Jake from State Farm and Judy from Progressive and all these warm, fuzzy characters. And that's the irony. But the truth is, imagine society without trial lawyers, what corporate greed would get away with. So I've shared my feelings about this with Esquire Bank, and they said, you know what, we want to do something about this. So this year, we've launched the Social Justice Campaign. Our goal, Keith, is to shine a bright spotlight on the important work that trial lawyers do for society. And we've taken a number of videos from some great trial lawyers who have worked on cases that have led to important, impactful change in society. And I will drop the link to this site into the chat as well, and I'm sure you will share it. And we are putting millions of dollars behind this campaign, and you'll start seeing it on law.com, the New York Times online, and Wall Street Journal, and everywhere. I invite lawyers who may be listening to this to go to the site, and there's a link that says share your story. If you would like to participate and talk about a case or the reason why you got into trial work, let us know. You don't have to be a borrower or a depositor with Esquire Bank to participate in the social justice campaign. It's something that's really dear to our hearts, and I thank you for asking about it today.
Yeah, great. And I do see it in the chat here. We're going to include these links and what we put out to everybody, and also they'll be on our masterclass site. They'll be able to access all of this. And I tell you, I don't have a whole lot of other questions for you. You've really educated me very much today, and I think it's gonna be very educational for the law firms that are smart enough to watch this.
Well, that's great. I would love to just
they need you. They need you. Yeah.
You know, for lawyers that it's amazing. I still meet lawyers who I speak to for the first time and they go, oh, I didn't realize you were a bank, although it's Esquire Bank. There's still some misinformation out there. They may think we're a litigation funding company. Litigation funding companies that lend money to law firms, Keith, they don't take deposits. So they need to borrow money first from investors or hedge funds or private equity funds.
Yeah.
Then lend to law firms. That's why their rates are 18% a year, 24% a year or more. Okay, and there's a place for them. But I want to make sure that everyone on this call understands that Esquire Bank is a national commercial bank. So that means we're regulated by the OCC. It means we have the same FDIC insurance as every other bank out there. But I also want to say that we're one of the strongest, healthiest banks in the country. And that's not just me saying it. Raymond James, the investment bank, every year looks at every publicly traded community bank in the country. We became a publicly traded community bank in 2017. We're now publicly traded on the NASDAQ under the ticker ESQ. So Raymond James looks at over 2,500 of us every year and ranks the top 250 based on banking fundamentals. They named Esquire Bank the #1 publicly traded community bank in the country last year, 3 of the last 5 years, and the other 2 years we were either 2 or 3. Now the accolades are great, but it's more important now than ever because last year, while 3 banks in the US failed, we were being awarded as the strongest, healthiest, most liquid, well-capitalized, publicly traded community bank in the country. And those banks failed because of low capital. We have twice the amount of statutory required capital. They had liquidity issues. We have excess liquidity. They had uninsured deposits over 90%. We have under 25%, and they're part of a bigger relationship. They had exposure to crypto. We have zero. And those banks would leverage their balance sheet to boost earnings. We've never done that. So I also want the listeners today to understand that, look, we're unique in that we really understand your business. We love your business. We're supporting it in so many ways. And we would love to speak to every lawyer listening today to have a 15-minute business conversation and see if maybe there's a good fit. After the IPO, Keith, we became also a merchant acquiring bank very quickly. We realized and surprised there were only 80 banks in the country processing debit card, credit card, and ACH transactions for small businesses. So we invested in the technology and the talent. And last year, we were processing for over 85,000 small businesses in all 50 states. And we processed over $40 billion in transactions. That generates non-interest income, fee income. That allows us to give away our banking services for free. So any law firm who's being charged to bank with a local bank, come speak to us. We understand your business. We want your business. You can bank for us for free. If you're self-financed and you want to maybe think and learn and become educated about smart debt, reach out. If you're with a litigation funding company and maybe you could get financing that is much less expensive, talk to us. We're here for you. So I really appreciate you giving me the platform to talk about what Esquire Bank does and how we do it. We're really proud of what we're doing, and we can't wait to just, work with more and more law firms.
Yeah, and it really and you're welcome, and thanks for being here. It really comes across from you and your excitement about the bank, and it just sounds so healthy and like such a great resource for law firms. Look, tell us real quick here as we close. First of all, you can, if you want to mention anything else or talk about anything else, we can. But how would someone begin the process of working with Esquire Bank? Would they schedule a quick call, as you just mentioned a few minutes ago? You've got your email address up here. That's great. Would they also, is there a link to an application, or you probably start off with the call? What do you?
Yeah, you know what? Unlike other banks that send out applications and a list of everything they need to underwrite to see if you qualify, we much prefer to do this in a few steps to be respectful of everyone's time. Let's have a business conversation for 15 minutes. And if it seems like there's a fit, the way to get started is we send a link out and a request for like 5 things. It's so easy. Export your case out of your case management software, your active docket. Out of your accounting software, tell us how much you have out in case costs. Again, that's our collateral. Then let's get some recent financials. Last year's year-end P&L and balance sheet and a couple of prior years' tax returns. That's it. If you're willing to share that, upload it with us. Upon receipt within 1 to 2 business days, we get back to you and say, hey, looks like we can make X amount of dollars available to you. Now let's talk about how to allocate that across these different structures and solutions, right? What you're not hearing is a couple of products. We don't say, hey, we have these products. If you're interested, apply now. Again, we provide tailored financial solutions. So let's have the business conversation. If you're looking to hire, if you're looking to grow, if you want to change your retainer agreement, finance case, really depends on what your goals are. What do you need to achieve your goals? And in addition, what do you want? We strive to give you what you need and what you want, give you the financial confidence so that you're as confident in your office as you are in the courtroom, and help you run your law firm like a successful, profitable, liquid business. We can literally help lawyers and law firms do that.
I love it. It sounds like you guys really take it almost as you're a business partner approach, and that you're going to do this together, and it's not a cold binary situation. It's a situation where you guys really learn about the firm and you dig in, and again, you're so uniquely qualified to do it because of your background. And I really appreciate you being on here today and helping us, being a part of the CMO Secrets podcast. And I'll leave you just by asking, is there anything else you'd like to share or discuss?
I'll end with this. We are the bank of AAJ. We're the bank of the New York State Trial Lawyers, the Pennsylvania Association for Justice, CAOC, and others. We are involved with many state and county and national trial lawyer associations. We're constantly giving back. We are aligned with the Trial Lawyers of America. Our country's largest banks are some of the biggest financial supporters of tort reform. So there are a lot of reasons to speak to somebody from Esquire Bank. We have people now around the country in different states who are brand ambassadors and business development officers. So just like whether it's PILMA or AHA or MTMP or NTL, we're out there, and we would welcome the opportunity to speak to anyone who wants to speak with us.
Ari, thank you so much for being on today, being a part of the CMO Secrets podcast. And I look forward to doing it with you again. I'd like to do this maybe a couple times a year if we can.
I would love it. Thank you, Keith.
All right. Thank you, sir.
Take care. Bye now.
Thank you for tuning in to this episode of The Circle of Trust. If you found today's insights valuable, consider subscribing, rating, and reviewing on your preferred podcast platform. Your feedback fuels our mission to bring outstanding content. For additional resources, show notes, and exclusive offers, visit our website at LEXGRO.com, where you can join our platform for free. By joining the platform, you can take our marketing training to become certified in law firm marketing and intake. And you can hire fractional executives and trained virtual assistants to easily implement your marketing strategies. For those ready to take action and explore how a fractional chief marketing officer can transform law firm success, scheduling a strategy call is just a click away. Simply follow the Calendly link in the description box below. Remember, the journey to 7 to 8 figures starts with the right strategies and support for implementation. Join us again next time for another exciting episode. Until then, listeners are encouraged to keep innovating, growing, and uncovering the secrets to predictable and consistent growth. See you next time on The Circle of Trust. Let's grow with LEXGRO.